Hi, Charles Sizemore, Chief Investment Strategist at the Freeport Society. And today we're going to look for value in the AI economy. Now that's sort of a relative term these days. As I myself have said, we are in something that's starting to resemble a bubble in the stock market. The S&P 500 trades at about 30 times earnings. That makes it one of the most expensive markets in history. But if you look at sales, it trades at about 3.3 times sales. That makes it literally the most expensive market in history. When you start digging into individual names, it can get even a little bit more extreme. NVIDIA, the world's most valuable company, valued well over $4 trillion now. That's roughly the size of, well, it's actually bigger than any economy in Europe except for Germany. And depending on how you measure the German economy, the exchange rates and whatnot, it's roughly, it's either a little bit smaller or a little bit bigger than the entire German economy. And that's just one company. Of course, it's a profitable one, but you do have to ask, what comes next? So to help me kind of untangle all of this, to kind of are we measuring value right? Just to pick through the pieces here. I brought on the illustrious Kai Wu. Kai, thanks for joining us.
Thanks for having me.
Now, you're the founder of Sparkline Capital, and I want to point out to our viewers here that you studied under a personal hero of mine, Jeremy Grantham. Grantham, for those who aren't familiar with him, he's most famous for calling the dot-com bubble back in the late 90s, and then again successfully navigating the 2008 financial crisis as well, and then beyond navigating 2008. I remember a piece he wrote called Reinvesting When Terrified about getting invested back, when everybody else was running for the hills, he was then, redeploying. So he's a bit of a legend in the space, and that's where you cut your teeth in your career.
That's right. Yeah, I actually was an analyst on his team when he was writing that Reinvesting When Terrified letter. And so some of the number crunching in the background, the credit goes to me, I guess.
Well, so you went solo. You started your own investment firm here, very research heavy, which I like. You're very much a numbers geek, and I love that. I'm the same way. And one of your, I guess your main focus is actually finding new ways to value companies. And part of this comes back to the fact that our accounting system is old. And it was really developed at a time when companies were valued more on tangible assets. When you were, making cars or making appliances, making heavy industry, your factory and your hard capital there, that's a big part of the business. But we're now in a very capital light economy. It's an information based economy. So those old metrics may or may not really makes sense. So why don't you talk to us a little bit about, how did you, what drew you to study intangible assets? How does that factor into your valuation of companies? And then after that, why don't we go into some details and kind of see how it applies to today's market?
Yeah, thank you. And I think that's a really succinct and accurate summary of, a lot of the research I've been doing. And look, my interest really starts because, as you pointed out, I began my career studying under Jeremy Grantham and GMO, who, of course, was a pioneer in quantitative value investing starting in the 70s and 80s. I showed up at work my first day, and my manager, Edward Chancellor, actually, who wrote Devil Take the Hindmost, a famous historian in his own right.
That's actually on my bookshelf somewhere. I'd struggle to find it right now, but it's on this big wall of books somewhere. Great book.
It's a classic, one of the best books. I literally just recommended it to a student who reached out to me yesterday. So I get the book. It's security analysis, plopped on my desk. I'm told to go read this, that's your first assignment, get up to speed. And, you're just reading through all the examples. And, the frameworks are, of course, timeless, and I understand how it, translates to today. But a lot of the examples are like, steel mills or railroads, very industrial companies that, quite frankly, are not a huge part of the economy now. Right. And that's kind of what I think initially kind of set me off on this path to say, if the economy is so different today that the biggest companies are NVIDIA, Microsoft, Google, Apple, these asset-light businesses, to what extent does the, both accounting methodologies and frameworks, as well as the, tools that security analysts and in particular value investors use to evaluate these types of companies, do they need to be reformed? And so that really is what set me on the path to study intangibles. A lot of research papers I've written and kind of digested what academics and economists have written on the topic. But just to give you some high level numbers, I mean, for the longest time, tangible investment was an order of magnitude larger than intangible investment. And then around the 1990s, around 95 actually, is when intangible investment crossed as a percentage of GDP and surpassed tangible investment, and then never looked back. Right, the alligator jaws have only continued to expand.
Let me get a word in there, because you brought up a point that I want to touch on. Before the 90s, that was the big tech revolution decade. Before the 90s, intangibles were really more just brand equity. So the McDonald's golden arches, like that wasn't in the ubiquity, the recognizability of the golden arches. That was an intangible asset. Mickey Mouse's ears were an intangible asset. That's kind of what we were limited to back then. Branding, right? And then the technology revolution happens, and you said that the break point was kind of the mid 90s there. That's no coincidence.
Yeah, I mean, it's funny you bring that up. My most recent research paper was on Warren Buffett, actually, and I kind of traced the evolution of his investment style through 3 eras. So the first era was when he was a direct disciple of Ben Graham, who wrote Security Analysis, the father of value investing. Yep. And his iconic investment was Geico, a kind of more traditional asset-heavy business, and of course Berkshire itself, an industrial mill. And then phase 2 was when he bought Coca-Cola through the 90s, Procter & Gamble, Anheuser-Busch, a lot of these more brand forward companies, See's Candy, of course, and then more recently, Apple has been his big investment. He's made, I think, $120 billion on that single stock. And so after years of kind of eschewing technology, he said, you know what, this is too big a part of the economy, I can't ignore it. And the way you trace his evolution through those cycles very much mirrors what you mentioned, that the economy itself evolved from industrial to brand forward, franchise driven, down to and then eventually to technology and network effects and human capital, these other intangible assets that dominate in the technology sector. And so Buffett, of course, is a brilliant investor, and more so than his intelligence, he's obviously well known for his adaptability, right? Being 94 years old, yet still managing to evolve with the economy, and that's kind of what's led him to be so successful over multiple market cycles. So I just think he's an interesting, character, an interesting kind of parable to what we, just are going through in the economy and in the markets, more generally.
Yeah, you bring up Buffett. He's an interesting guy because of his humility more than anything else. People still associate him with value investing, and he hasn't really been a value guy. As you pointed out, that was phase 1 of his career. He was a Ben Graham guy. Somewhere along the way, probably the late 70s or early 80s, he threw Ben Graham out the window, and he became more of what you might call in kind of today's MBA language, like growth at a reasonable price, GARP, something like that. And he really hasn't looked back. He's gone, his mantra became, buy, excellent businesses at decent prices as opposed to, decent businesses at excellent prices. That flip happened, that he never looked back. And for a guy that, how old was he when he made his first investments in Apple? I mean, he had to have been late 80s, I think, or if not already 90 at that point.
Was that like 2016 or 2018, I think? So, I mean.
So late 80s.
Yeah.
Yeah. So this is a guy in his late 80s made a major pivot, which, I mean, that just goes to show you how humble he was and how not, stuck in his ways, which that's something that most 20-year-olds don't have, let alone somebody in their 80s or 90s.
Yeah, no, I think there's like a funny story. It may be kind of apocryphal, but where he basically had Tim Cook himself show him how to use an iPhone because he was still using flip phones even back then. So I mean, again, like he's someone who's humble enough to be like, yeah, like this isn't really my thing. I'm not like a tech guy. I'm not like one of these guys, but I can see why this company is one of the best companies in the world, which he has called it before as an investor. And so again, that requires a certain humility and perspective that only the greatest investors can have.
Indeed. So let's talk about I don't want to call it the elephant in the room because that sounds ominous, but the company that's been really in the headlines nonstop for the last several months, that just reported earnings that were, in any normal world, their earnings would have been just eye-popping and just incredible, but because they've set the bar so high, Wall Street just sort of yawned. I'm talking, of course, about NVIDIA. And I know that your methodology got you into NVIDIA several years ago, and I know that you've since kind of lightened the load. Why don't you, well, actually, before we even talk about that, let's talk about that within the context of, how do you measure some of these intangibles? Perhaps we can use NVIDIA as an example. And I do know that, AI is everywhere, it's, whatever, but I know that you also use AI in your process to help identify intangibles and to measure that. So why don't we go there?
Yeah, no, that's great. So basically, our process is, starts with the kind of Ben Graham style traditional value idea of you're trying to buy assets that are below intrinsic value, right? That just is the definition of value investing. Now,
Sure.
To us, what's unique, I think, is that we define intrinsic value. We try to do it more broadly, right? A lot of the more, especially academic folks, will tend to focus on book value as being, the kind of way that they anchor intrinsic value, and that made sense, 100 years ago in the industrial era. But of course, today,
it makes sense with steel mills.
Yeah, it makes sense for steel mills. It makes sense for banks. But once you kind of move to technology companies, where book value is basically 5%, or in some cases they actually have negative book value. These companies, right? So it's basically meaningless for companies that are asset light. And so you need to figure out what other ways do I have to value the components of this company that actually drive the value today, and that would be the intangible assets of companies like Microsoft or NVIDIA. And we generally bucket them into 4 categories at Sparkline. So we have intellectual property, and that's like patents, but also trade secrets, any kind of software, innovative properties. 2 would be brand equity, which you mentioned. 3 is human capital. There's a reason why Zuck's giving billion-dollar deals to AI engineers, and then finally network effects, and that's just the idea of think about Uber or Facebook. Like their value is not on their balance sheet; it's the kind of platform economy that they command, or the Apple iOS store would be another good example. So those are kind of your 4 pillars, and the concept here is, can we now by expanding the definition of intrinsic value to be not just tangible but intangible across these 4 dimensions, can we attempt to now quantify intangible assets for companies and therefore build up a balance sheet that, say, for NVIDIA, isn't just the kind of sliver of book value, but is includes a much more prodigious amount of value that is their intangibles, and then against that compare price or market cap in this case, and to the extent that market cap is below that estimated modeled value, then it's an attractive company, and if it's above, then it's expensive. And of course, we're always going to be looking for stocks with margins of safety that are trading at relatively deep discounts to that estimated value. So you mentioned the use of AI tools, right? So we're not just trying to find companies that are innovative, of which AI is one, but not the only of many different ways companies can be innovative. But we're also using AI as a tool to help us quantify intangible value. And the reason this comes into play is when we first started this process, the first thing we did was we said, what if we one of the problems with accounting data is the inconsistency in how they capitalize R&D as opposed to physical capex. So accountants will allow companies to put, if you build a factory, to put that onto their balance sheet and then you depreciate through time. Whereas homegrown R&D, if you're inventing a new drug and you're building out the patent that will eventually become Ozempic, that doesn't go on your balance sheet. That actually becomes expensed, which is a penalty for most companies that are investing heavily in intangible assets. Same with sales and marketing. And so the first thing we did was we said, what if we reverse that process? And it helped, but it was not a very complete picture because so much of the information that would pertain to intangible assets are actually not captured by accounting data, but instead are in kind of what you would call alternative data or big data today. Right? Keep in mind that 80 to 90% of information is unstructured. It's alternative. It's not in the 10Ks. And so examples of data sets that we have looked at include patents and trademarks, LinkedIn profiles, Glassdoor reviews for company culture, social media, job postings. Right? So all these sorts of things you can kind of see intuitively contain information into each of these 4 different pillars. And now the challenge is a lot of this information is unstructured, as I mentioned. You can't just take a long trademark or patent abstract or a job posting and put it through a linear regression or any traditional quant tool. It's not going to give you anything meaningful. Right, so that's why we started developing.
What do you do with that, right? What do you do with that information? Like it's interesting, but how do you put it into practice?
Exactly, and that's where the NLP or natural language processing branch of machine learning, which has now evolved into full-fledged large language models, has been a game changer, right? Like historically, if you wanted to go read 2 million patents and score each one by how innovative it was, you'd have to hire a huge team of analysts. Maybe you outsource it offshore, but I mean it's still a ton of work and very subjective and slow and time-consuming. Whereas nowadays you can literally just feed that information to a large language model, give it very strict parameters, but because it's a pretty simple question. Is this patent about AI, for example? Right? That's a pretty basic question.
Let me step in 1 second just to clarify one thing. For the uninitiated, the large language models, that refers to applications like ChatGPT, for example. That's a good example of a large language model. Not the only one, but that's the household name.
That's right. So, the back end of ChatGPT, the actual model that drives its intelligence, is a large language model. There are other models as well, but that's kind of the most famous. ChatGPT being kind of a front end, a way that you as a human can interface with the model. There are other ways as well, like through APIs and such. But I can go back and trace the evolution. Basically, the first thing we did was we said, let's just do something very basic, right? That you don't need to be like a computer scientist to understand. Let's just do word counts. Let's just read each patent, put it into a computer and read it, and just count the number of times it mentions, a series of words that which we can predefine to be considered kind of cutting-edge technologies. That would be one way to do it, right? And obviously, it's very crude and it's not perfect, but it's a step up from nothing, from not including the information at all.
Sure.
Right, and then from there you can do the next step, which would be these things called word embeddings, which is a technique invented by Google 20 years ago or so, 15, 20 years ago. That's a kind of think of it as a mini large language model. And then you can, of course, go to full-fledged large language models. And each step, you get better and better, right? So think of it this way. There's a lot of information that's kind of floating around in these data sets, but it's sort of not able to be captured because it's buried in there and, incomprehensible to the average, computer. But by applying these tools, you can kind of get progressively more and more as a percentage of that value out. So, over time, even as large language models have gone from GPT-1 to 2 to 3 to 4, now 5, we've seen consistent and monotonic increases in the amount of, information or insights that we can glean from accessing these different documents.
Yeah. Yeah, I love that. I mean, the information's there. There was no way to really parse it, though, before. And now you have the tools to do that. Now, one of the things you mentioned that caught my ear, you mentioned that you mine LinkedIn profiles. So without giving away secret sauce or anything like that, tell us how that works. What information do you glean off of LinkedIn profiles?
So there's kind of two ways to look at it. First is as a snapshot in time, right? So for any given company, you can say, what does their current workforce look like? How many senior, junior, mid-tier employees do they have? What is the educational background of the various employees? Do they have, PhDs from MIT or bachelors, or kind of where did they study? What subjects, are the expertises in? Where do they live, right? You can kind of see which companies outsource versus insource. You can also look at the flow of human capital. This is really interesting because, presumably, if you're a company that's able to hire talent from the most prestigious and kind of plum jobs, basically big tech over the past 2 decades, if you're able to kind of poach talent from Google, that means you're probably pretty good at what you're doing and you're doing something right. So that's two different ways that we look at it. We also look at job postings, as I mentioned, more as a kind of forward-looking indicator, so like a flow versus a stock, and that's really interesting too because it has written into the descriptions what skills these jobs require. So any CEO can say, we're investing in digital transformation, we're investing in AI, but are you really? And the way you find out is you say, are they actually paying these premium salaries to hire talent, these engineers with very specific skills? Like the best example would be going back to NVIDIA, CUDA. Anyone who knows how to use that is very likely to be, someone who's technically competent in AI. PyTorch or TensorFlow being other frameworks that are used to train AI models. And so, if you see that show up on a series of job posts, that company is probably taking AI somewhat seriously, as opposed to just like talking about it on their earnings calls, which anyone can do.
It's not just AI washing, which is a thing where you just sort of paint anything with an AI brush and dress it up, and it's sort of like the equivalent from the '90s, when it was just everything became .com. And that's you put .com at the end of your company's name, and your market valuation went up by 5 or 10 times. That's you saw some of that more recently with anything related to AI. So this is your way of sort of filtering out that noise and getting to the meat.
Exactly. Yeah, it's like kind of the ground truth to kind of cut through a lot of the hype.
I love that. So walk us through. It's because a lot of people are going to own this stock. It's, like I said, it's the world's biggest company. It's the only company that matters right now. Walk us through NVIDIA. Like you were overweight to it. You were overweight that stock a while, I believe, and I believe you've been reducing your exposure to it. Just kind of walk us through what you saw in it originally, how it popped up, like what jumped off the screen, and just kind of walk us through that.
Yeah, so I think you have to rewind to mid-2021, which is when we launched our fund. And, basically the stock was trading, NVIDIA was trading at a P/E ratio of about 100, right? I don't know what the price to book was, but it would be similarly kind of astronomical.
It's something that jumps off the page and you think, oh, this is too expensive, I'm not going to touch this. Right.
Yeah, for any kind of self-respecting value investor who cut their cloth, in the Ben Graham, Warren Buffett style, sure. It would be sacrilege to own a company like that. They wouldn't go anywhere near it. And so we were somewhat unique. Like we bought the stock, and I think I'd like to mention this, that the Wall Street Journal actually wrote an article called and they called this the value investor buying big tech stocks, which at the time I was like, that's kind of like an insult, but I kind of now looking back I'm like, yeah, that was a nice thing they wrote about us. But yeah, I mean that was the thing, because if you look at NVIDIA in 21 based on traditional metrics, it seemed expensive on pretty much all, no matter how you slice or dice it. But then once you add these intangible assets into the mix, right? Like you look at its patents, you look at what sorts of people are employed there. You look at like what sorts of technologies it's working on. The network effects baked into CUDA, which I mentioned already. Anyone who wants to develop in using these frameworks has to learn that thing, and that's a thing that's managed, a toolkit that's managed by NVIDIA. So it kind of creates a lock-in effect. You don't want to have to reprogram your entire stack.
No.
We also looked at like Glassdoor reviews was a big thing that was positive, a green flag for NVIDIA. One thing we found, just to step back, is that like the Glassdoor reviews allow employees to like review their employer, both past and current employees, anonymously, and it gives you the option to kind of put a star rating. Oh, I think this company is a great company, or the prospects are good, or from 1 to 5. One thing we found was that star rating is not that useful as a predictor of performance. What is predictive is actually looking at the text, and this is where, again, the natural language processing comes into play. If you can parse the text the correct way, you can find interesting dimensions of company culture that are good. And in this case, people were very uniformly, it just jumped out at you, how everyone was really excited about NVIDIA's prospects with regards to its innovation. This is a very innovative company. People were like, yeah, it's kind of a hard place to work. You have to work a lot, but we're really excited about it because it's just, we're working on the coolest stuff. And so you put all those things together, and the value of the company is actually much higher than it would otherwise look. And that's why we actually thought it was one of the cheapest stocks available, and because we have a pretty stringent score when it comes to deciding what could make it into the portfolio. And it was in the top, let's call it decile of companies in the US. So that was a nice stock. And then over time, what happened was just quite frankly, prices went up. Right. So as a value investor, you need to have some discipline on the sell discipline, and have a target by which at some point you're like, this is a great company, we still love the company, but like it's 10x or whatever, due to a lot of the hype around AI, it's almost become memified in many ways. And so looking back, of course, we sold it too early, which is what value investors will always do. But the good thing is that you can then. It's not like we're not investing in AI. Of course, we still are. It's just we're looking for kind of more second-order derivatives. And I don't want to ramble too much, but we spend a long time like studying historical technological revolutions. And one of the big things that we found studying the .com boom and bust, right, is that the way you want to play any kind of technological revolution, which is almost always going to be accompanied by a bubble, is to start off with like the innovative companies like the NVIDIAs or the Ciscos. But as they get bid up in price, you want to rotate into the kind of the next tier, the early adopters. The companies in the old economy, for example, the second order players that will benefit from the technology, but aren't necessarily trading at that massive premium because of the hype around the technology. And so that's kind of implicitly what the models have started to do, as the kind of primary beneficiaries of this AI revolution are becoming, priced in, trying to find what are the second order guys who are, still trading kind of at roughly the same multiples as their peers who are perhaps investing much less in this technology.
A fun example, and I don't recall if it was you that told me about this or it may have been a different conversation, but the most old school, boring, old economy stock you can think of, John Deere. They make tractors and harvesters and boring farm equipment. You would think that there is nothing more anti-AI, just, old school knuckle dragger than that. But no, like they're actually a fine example of a company really using it. Like they have autonomous tractors and harvesters now. We have a labor shortage in the United States that's not going to be alleviated anytime soon. It's like this is this is a permanent fixture at this point, and it's even more acute in the rural areas. And if you're running a farm, well, just good luck getting labor, right? The labor was never born, right? So having a tractor that drives itself, having a harvester that runs itself and could even run at night, and it's not beholden to normal working hours. That's amazing.
Yeah, I mean, and these sorts of companies, like if you contrast, Deere or Caterpillar with like a kind of pure robotics startup, the robotic startup is working on cool stuff, but it's, priced that way. It's like a venture capital investment. Whereas like these more mature businesses have installed bases. They have like, thousands of tractors and other vehicles already on the fields and on the roads that they can kind of retrofit with new technologies. And same with like, think of in finance, like the big banks, right? There are plenty of examples of companies that, they don't trade at these crazy multiples, but it's pretty easy to concoct an idea of how they can benefit from a lot of the efficiencies that can be gleaned from AI.
Yeah, it's funny. One of the best examples, history never repeats itself, but it rhymes, right? To borrow from Mark Twain there. Cisco was a great company back in the day. They made some of the best internet infrastructure switches. They were the leader. Intel's a joke today in the chip world. I mean, NVIDIA left them in the dust, but there was a long time when Intel was the dominant cutting edge chip maker that nobody could touch. No one could compete with them. And what happened, of course, was they got ridiculously, no one's going to question the quality of the companies circa 1999. They were the best in breed. They just got crazy expensive. And when they, blew up, and I actually don't know that Intel ever saw its old 2000 highs. I'd have to go back and look. I don't know that they ever got back to those highs.
The fact that you have to ask.
Do what?
The fact that you have to ask.
Right. But, meanwhile, all of this infrastructure that was built back then, it laid the groundwork for new companies to use it. Like, for example, we would have never had a Netflix. Netflix would have never been economically viable were it not for all of the cable and all the fiber that was laid in the late 90s. We had a bunch of, thousands, tens of thousands, I don't know, maybe hundreds of thousands. I mean, I just put a few zeros on it. I don't know. Miles and miles of unused fiber optic cable wrapping around the world that was just dark. And that meant it was cheap. And so then, Netflix and YouTube come along, and all of a sudden we have businesses that use that bandwidth. And now, of course, they've grown into, I think, the two most important media companies in the world today. So we have no idea what the next company to come out of, when this AI thing finally busts to some extent, when there is recognition that there's overbuilding and, we have enough data centers and enough chips to, for we have more than we need. Prices collapse, and then newer companies will come take advantage of that. So that's of course down the road, but that's another exciting aspect of all of this.
Yeah, I mean, I think you bring up two really important points. The first is just that like a technology can be successful, yet you as an investor can lose money doing so, right? So like if you go back to the height of the dot-com boom, you buy a portfolio of the Ciscos of the world. It turns out that over the next 20 years, you 11x your sales. So in other words, the promise of the internet is realized. Yet, because the price to sales ratio of that basket collapses from like 30 to 5, you take an 85% hit in 2 years up to 2002, and you basically spend the next 20 years trying to grow your way out of that hole. So it takes you 20 years to get your money back, to earn a T-bill-like return. And yeah, you get there eventually, but like at what point, like at what time horizon is it reasonable? Like yes, Netflix came around and ended up being a great investment, but like that was many, many years later. So I think that's my first point is just that valuation matters a lot. Like, if someone tells you this is a great company, that's good to know, but like it also has to be, if it's baked into the stock price, and perhaps, too much, that could still not be a great investment. And then the second thing is, I think your point is just really, really important for people to think about, which is like this kind of like time lag thing, where it's like, these CapEx cycles, they go in booms and busts. I've been reading about the railroad boom, right? Because that was kind of the big one that happened before .com and even the technology sector took off. And it's just so crazy, like that you see the same kind of behavioral things repeat over and over again, where like there is a new technology. Railroads did change the game. They did change the way that Americans live, that our economy was structured. We could now
they
go
connected
to
the country.
California.
They made settlement to the West possible. Yeah.
I mean, and they were miracles, but like, along the way, investors lost their shirt. Like basically every railroad went bankrupt. And so I think the good thing, I guess, that gives me some comfort today is that like, unlike in the dot-com boom or the railroad boom, it's not like a bunch of, pure play companies that are like raising capital and, with a ton of leverage, a ton of debt, to build out the infrastructure. What's happening now is it's the, maybe CoreWeave aside, but most of the, hyperscalers are, extremely profitable, monopolistic businesses that are using their prodigious cash flows and perhaps will raise from the capital markets to do this, right? So it's unlikely, I mean, maybe never say never, but it's less likely to me to conceive of a repeat of the dot-com boom where like Google goes bust. But what could happen is that Google's their returns over the next 20 years are just more mediocre. Like I think, Charles, we were talking about this. Like one of the really interesting things is that Google, especially, is a great example. Like they had a search monopoly, right? Google search is like the crown jewel of capitalism. It's the most perfect asset-light business in the world.
Google was the internet. Yeah.
Yeah. And just amazing, right? So if you're investing in Google, it's incredible, right? And you're so happy until now Google is starting to ramp up their investments in physical infrastructure to compete in the AI arms race. And it's a game theory thing. You have to, because if they don't, then they risk being disrupted by whoever does win this. And so all these guys, I mean, Zuckerberg's talked about this explicitly, Sam Altman as well, that they're just, they have to win. They can't afford, it's almost a defensive play, right? So this is not like growth CapEx, it's maintenance CapEx. it's to protect the existing cash flows of their businesses. So these companies are now plowing.
Insurance policy.
Exactly. Yeah. I mean, and that means that the businesses are less attractive, right? Because if I told you, hey, you can buy this asset that has a great profit margin. Oh, but by the way, you have to buy an insurance policy now too that costs half the price of the thing. That's not as attractive a business. And I think that's kind of sort of what's happening. And you see these companies plowing hundreds of billions of dollars, projected to be trillions, into AI capex, building out data centers and such over the next few years. And like Meta is the best example. Their capex to sales is like 30%. That's the same level as the average utility, right? So now you're talking about a company with I don't know what the price to sales ratio is, but valued as a software asset-light business that's slowly transitioning into effectively utility, but the multiples don't reflect that. So that's a little bit concerning. And again, I don't think it's like going to go to zero. It's not going to be Global Crossing, but it. That kind of segment, that part of the business is definitely less attractive.
They don't have the debt load issues that Global Crossing did. You brought up a good point. They're reasonably capitalized companies that are equity heavy and they have profitable businesses. So this is not their only thing. So, but bankruptcy is not. We don't have to go there. It's just the question is, are they priced reasonably? Now that brings up, of course, where does this lead? Where are you looking today? Like, what looks good to you? Like, if you're willing to share a few names that your fund is in right now, I'd love to hear them.
Yeah, I mean, look, I think we can talk thematically is probably the most useful. I mentioned one area already, which is, we want to be long AI, we want to be long technology, disruption, innovation, but you want to, find it in more under the radar places. So don't just go out and buy kind of the obvious names. Like, you're not the first person to realize NVIDIA or Microsoft or AI leaders. Of course, everyone knows that, and that's the problem. So trying to find the kind of second order under the radar plays. And the other thing I'm doing more of, I launched a second fund that focuses on non-US stocks. One of the things that we've seen is, so if you're looking for ways, so one of the big challenges, to go back to this Magnificent Seven, these AI, hyperscaler companies, is that they're now 35% of the index, the S&P 500, let's call it.
They are.
Right? So if you as an investor own the index, you're basically making like a pretty concentrated bet on 7 companies, and these companies are all converging on kind of the same thing. At one point, they were doing different things. One was social media, one was like retail. Now they're all just trying to win AI. So you're making a pretty heavy bet on AI, and in particular a certain level of the stack, right? Like this kind of infrastructure and model layer, which is fine. I mean, maybe it'll pay out. Like I think there are reasons to be bullish as well that this technology will be transformative, and maybe these unlike in the .com boom, these investments will pay off, but maybe not. And if they don't, right, that's pretty bad, not just for these companies, but for the market and for investors. If a third of their money is tied to these companies that may underperform for 10, 20 years. And so that leads you to the question of where can you go elsewhere, right? So small caps in the US, value stocks, I mean, they've been laggards for 20 years. I mean, small caps, about half the Russell 2000 is unprofitable. So that's not, a great place to go. And that's really kind of what we're trying to do, is we're trying to figure out, are there other areas that are like less kind of overvalued in terms of, stocks in the US and abroad. International stocks trade on just headline valuation ratios at a 50% discount to US stocks. And yes, most European stocks are not innovative, they're not modern, and they, probably are just dead weight. But, that doesn't mean all stocks are, right? Baby with the bathwater. There's some small sliver of companies outside the US, that are actually, kind of part of the modern intangible economy. Not that we own these things, but, obviously ASML, TSMC, these things are, critical companies in the semiconductor supply chain, and should be kind of thought alongside NVIDIA as being kind of key, drivers of the AI revolution. So I'd say we're looking for ways to diversify outside of this kind of over-concentrated, relatively richly valued subsector of the market that's kind of now basically been driving returns over the past 10 years, US large caps, trying to go elsewhere and diversify, but using kind of our our intangible value lens, trying to find companies that are still levered to the intangible economy, which is what has driven growth and what will continue to drive growth, we believe, just given that, technology and information and, brands and human capital will likely continue to be the driver of human progress over the next century. So, trying to find intangible value outside of the Mag 7, I guess.
Yeah. Well, Kai, I enjoyed this. This was like a fire hose of excellent information here. Where can our viewers find more information about you and the funds you manage?
Yeah, so in terms of like the research we publish, it's all on sparklinecapital.com. That's SPARKLINE capital.com. We publish, I think we have about 24 different papers up. We have a few that are kind of more high level, what is intangible value, and others that are more methodological, how do we use AI, and then the bulk of the papers are actually deep dives on specific topics, like quantifying a century of innovation, or looking at how do you measure company culture, things like that. And then we have a separate set of websites devoted to the funds, and that would be like ETF.sparklinecapital.com, and they have information on like because these are ETFs, so they're public funds, what they hold, sure, and their performance and such.
Well, good deal. When I'll make sure to put links to that in when we post this video, and I highly recommend our viewers give them a look. He's doing really good cutting edge research here, marrying value investing to the modern economy, which I don't really see a lot of other people doing that right now. So it's good work, and Kai, thanks for sharing it with us.
Well, thanks so much. That means a lot.
Yeah. That'll wrap it up for today. So to our viewers that made it through to the end here, thanks for viewing, and we'll pick this up next time. Charles Sizemore, signing off.